Rohr here with early concise highlights on Wednesday, June 11th, 2014. It's currently 7 a.m. U.S. Central Time, and we are being concise today and only spot checking markets because so much of what's going on is consistent with our global view major video analysis from yesterday. And to start off with some of the macro background, remember we're coming in from last week's ECB meeting and U.S. employment with positive influences that carried through into Monday and Tuesday out of China, Japan, and the U.S. And it was interesting that this morning we had a first look at second quarter Japanese all-industry index and large manufacturing index, and they were extremely weak, but that's not surprising. Everything is going to be weakening right after April 1st in the wake of that Japanese major consumption tax hike, and yet their more recent corporate service price index, corporate goods price index rather, was up, and that goes back to the more positive indications from last month in May. Positive Australian consumer confidence, UK employment, and very light day in the U.S. today, headed into more extensive influences, especially Thursday out of U.S. retail sales, and again on Friday, where amongst a lot of other things we see quite a bit of Chinese data. So the question is, with all that positive data, why is this S&P future, as we move over to the short-term charts of the S&P, why is it off $9 down at 1941? And the answer is possibly some concern about U.S. political disruption again. The shocking defeat of Eric Cantor, representative from Virginia, who was overturned by a Tea Party candidate who spent almost no money and is a relatively unknown university professor, has set the cat loose among the canaries again in the U.S. political scene, where a lot of people are feeling there is a very heavy Tea Party far-right influence, which they had hoped they'd seen the end of in the Republican Party. But it's back, so we would think, at least from the headlines from that result. Now, the actual movement here is very interesting in the short-term S&P charts, because we formed a micro head and shoulders top out of the gap up Friday through the further push up Monday into Monday's slide. So this would have been the left shoulder in the reaction late day Friday before it pushed up again, and then the head at the new high and the intervening low with the right shoulder forming later on Monday into the drop yesterday. And this left a down break right around 1946. And it's important that from the neckline to the tip of the head is approximately $9. And while the bulls managed to hold the line, not let that down break feed on itself from early yesterday, it was important to get back above the high of the right shoulder, which was the late Monday high at 1951, which also, on what we call a confluence of factors, different things coming together, was also the down break out of the aggressive up channel going back to last week on Wednesday, when the market churned a bit in front of the ECB, and ECB and employment subsequently put the market up so sharply. So nice rally back up, bulls, but if you couldn't get the market above 1951, it was vulnerable, and now here we are more so down around 1941. However, that said, the downside objective with the $9 count here is into 1937, and you have the gap up from Friday from the positive response to the U.S. employment number after the rally Thursday on the ECB. That was right around 1938.5. And of course, interestingly enough, the runaway gap that happened back coming in from the Memorial Day weekend a couple weeks ago set an objective of 1938. And as we get out into the later part of this morning, the period just before lunchtime is going to bring us the overall upward channel from the last reaction low down at 1865 is also right into approximately 1938. So we need to watch 1938, and the market's already, of course, very close to it being down in this area. We'll have to see how it goes. What we know on the short-term indicators, though, is that this is not going to help the bulls. The short-term stochastics are going to turn back down temporarily. The MACDs are going to remain negative, and we'll have to keep an eye on that. And that's pretty much it for the short-term picture. On the intermediate-term view, we can see very quickly how the gap out of the 38.5 area still represents some support, and it's also getting near the 9-day average. And if the market should not succeed in holding, if it breaks back below 38, important also is the upside objective, then you look for support back at 1925 to 20 range. And our higher resistance, if it should get better above 51 again, will remain up toward 1970 to 75 on the weekly oscillator and the daily topping line.